everyone, and thank you for joining us live today. I am Bridget Height, host and moderator for Oak Street Funding On Point webinars and podcasts. Today, I am happy to be joined by Bruce Morin, Vice President of Strategy Markets here at Oak Street Funding, and Bob Lewis, President of the Visionary Group. Feel free to use the chat on your right side of your screen if you have any questions for Bob or Bruce. And you will also receive this content in the next few days with their contact information as well for any follow-up. And we have only 30 minutes today, so let's get started with an overview question from one of our registrants. Bob, I will start with you. So how long is the ideal deal when selling a firm or buying another firm?
Okay, so there's really two pieces to that question. There's obviously the sellers and buyers. There's two different components. If you're selling a firm, typically the deal can go quicker because you already have an asset that's going to go to market. So the question is finding the right buyer. We've always found those to be a shorter cycle. However, the shortest cycle we've ever done has been 2 months. And everything was very aligned in that particular opportunity. If you're buying, that's typically going to require a little more time because you have to find the right person to acquire or merge into you. So you're a little bit, you're searching, and the search can go a little bit longer. We've had some clients that search for a couple of years to find the right fit because they're only going to take a deal that's good. So you're really looking at a minimum of 2 months, likely looking more like it's 6 months. And if you're really doing a continual search, that's just going to continue to go year after year after year looking for the right opportunity. Bruce, what's your experience been?
So my side of the equation is lending. So obviously that's a little bit different from what Bob's discussing. So in my view, it's 30 to 45 days from start to finish is the ideal time. If it was my client's decision, it would be tomorrow. But we try to land somewhere in the middle just to make sure everyone's prepared to get this thing done from a financing side. By that, I mean make sure your financials are up to date, the seller's financials are up to date, and all the information requested from a borrowing side are delivered. But yeah, definitely 30 to 45 days is a good thing to shoot for from an acquisition.
Right. So just think about this as like 2 stages. So your first stage is really the hunt. Either finding the buyer or finding the firm to acquire, which can be a much longer variable. Once you've got one locked down and you've got everything in order, going over to Bruce or for the financing arm, like you said, it's a much shorter time frame. But you can tack that onto the back end of the cycle or in the middle of the cycle. If you haven't quite completed the deal structure, you can still get most of the other pieces lined up. So and it is an interesting market out there right now, Bridget. Let's leave it at that. It's a very interesting market. Every day brings a new opportunity. Some are fun, some are problematic right now, and I think it's going to continue for quite some time.
Okay, the next question I have is, I am interested in the accounting firm market and what it takes to buy a firm, as I hear PE is driving up prices.
So Bruce, you want me to take that first?
I'll do my side first since it's probably going to be a shorter answer than yours. I've got a couple firms right now that actually use PE money to help with their acquisitions. But these firms, the PE firms that I'm discussing, they're more passive and they're looking for longer term, gains from their involvement with these accounting firms. And they let the ownership right now determine the pricing or on what they're going to be buying. So anywhere from 0.8 to 1.2 times is like the typical market right now with my guys driving the bus. With the PE money behind them as the cash into the deals, they're really not actually determining what the price is. So my aspect's a little bit different than what I think Bob's going to answer right now.
Well, there's some overlap there. So part of the story on the private equity right now is, it's widespread in the accounting profession, and I don't think it's just limited to the accounting profession. We have begun a lot of non-accounting firm mergers and acquisitions. So we're looking for tech companies, medical consulting companies for our CPA firm clients to acquire. The private equity money's been in that space for a longer period. So they're used to dealing more with multiples. One of the things we're finding right now changing in the market in terms of values with private equity, which, like I said, every day is like a new adventure. You used to price things off of EBITDA, okay? Now we're finding some of the tech firms and some of the consulting firms that haven't really developed a strong EBITDA because they're either investing back in the company or they haven't made the profitability they thought. They're now changing the pricing structure to a multiple of revenue, which goes almost back into how the CPA firms have been doing things for, it seems like, the last 2 or 3 centuries. The private equity market's getting really interesting. We've been contacted by several private equity companies just in the last few days, and many of them are trying to figure out what the play is in the market, where to go. Everyone wants to start at a $100 million plus firm. When you look at the CPA firm market, there's like 15 firms that are $100 million plus. It's not a huge number. Go to Inside Public Accounting and look up the list, and you can see the number. And even like the $50 to $100 million range, it's still a fairly limited box of people. So what everyone's trying to figure out is, in the PE side for the CPA firm, is it a long-term play? Like Bruce, as you indicated, if you've got a client that's in a long-term play, or are they doing it more for the short term? The typical answer we've seen so far is looking at probably a good 3 to 4 year window at least. Some are buying it to hold and resell. Others are buying it, like the one we talked to yesterday, they're buying it to then introduce their wealth management arm, their insurance services arm, their cyber arm into the client base.
And to that point, I mean, two of the verticals that we're in besides accounting firms are insurance and RIA firms, investment advisory firms. And to answer that question, as far as they're definitely driving up the multiples on the PE side on that side, because the acquisitions are going through the roof. It's not really impacted the accounting side too much yet. And the hold periods on these PE guys that are getting into the accounting are 7 to 10 years. That's what I've been hearing right now. So I don't think it's really been impacted yet for these multiples.
It really hasn't, and I think the whole market is still really exploratory. The other thing we keep hearing now is, a lot of the transactions that have occurred, because one of the core differences in the accounting profession, if you're doing insurance work, that has to be put into a separate entity. So you have to create an alternative practice structure to make that work, because of ownership can only be in the insurance function. I think it's 60% owned by a CPA. Okay, so they've had to do some separation of the businesses. But one of the other things we're seeing too is, or haven't really witnessed it yet, to be honest with you, I'm hearing it, is a limited controlling interest. So instead of me buying 70% of Oak Street Funding, I buy 35%. So you still have controlling interest at Oak Street Funding. If I were to buy, put private equity to buy your organization, you still have controlling interest, but I would have 35% ownership. Now that, to me, changes the whole market in the CPA profession, because the principals that were in charge can still remain in charge. They're just going to get funding to help them execute some of their plans, which may be to pay out the exited partners or exiting partners, take some money to buy a tech company or some other auxiliary businesses to make investments in technology. And that's not such a crazy option. So I think that's one of the tools that's going to come into play. What I have seen, there was some firms that are smaller, and smaller, by the way, meaning like $5, $6, $7, $10 million, that have been bought by private equity already in the CPA profession. Now, that's an interesting model, because I haven't quite figured out who's making those acquisitions, but I do know that just about every CPA firm in the country, more than a couple $1 million, seems to be getting inundated by private equity calls. Because every major party we talk to says, yeah, I get 2 or 3 of them, a week at a minimum from different private equity companies.
Well, they definitely solve problems. I mean, with that kind of capital coming in, as far as deferred comp and things of that nature from succession. So it's a different aspect, which is great for the industry. I mean, it just keeps it fresh, right?
It's another change. It's a layer change. And honestly, I think it's going to force more and more firms to get, I don't want to use the word out of compliance, because compliance is what they're there for, the core function. It is always going to be the revenue stream, but it's going to force more and more to diversify in the advisory sector. And we are seeing firms from like $10 million on up, 20, 30, 40% advisory revenue now. And we're not talking about like tax consulting as advisory. We're talking about pure management consulting or different service models like a cyber or a wealth management, which to me is a really missed arm still. I think investment banking is another huge area for CPA firms to get involved in, because they have so many clients that need to sell because of the aging baby boomers. And there's a lucrative revenue stream inside that investment banking arm that also feeds valuations, estates, trusts, a whole bunch of different areas, plus the whole wealth management side.
Bob, I'm very eager to move on to this next question. Will Bob be demonstrating how he uses his sledgehammer to close deals?
Okay, so the sledgehammer is too heavy now. I'm older now, so I need to go to a smaller, like little mallet. But I think I know that there's a client who's registered for this. I'm pretty sure I know asked this, but I will not call them out. The The issue on this sledgehammer is, and he's kind of, I know he's joking a little bit, but there's some truth to that. We've been having a lot of tough love conversations with firms. Firms that have too many 1040s, too low a price on 1040s. To us, that tells us a lot about the pricing of the firm overall. And we've had quite a few conversations just in the last few weeks with firms saying, look, here's the situation. Our client would like to proceed, but we're going to have to increase the 1040 fees by probably at least 50%, and then maybe again 50% the year after. And whatever falls off, because we can't afford to do the work at the level that they're at. Plus, to be blunt, inside a lot of firms, there's staffing shortages. They really don't like doing the 1040s, and it chases away a lot of staff. The bigger thing though is when you start peeling back the layers on that, we also find out their accounting services are a little underpriced, so their overall, business tax work and the rest of it. So fee increases are almost mandatory inside the CPA profession right now because of staffing shortages. And what most firms are finding is when they increase fees, there's almost no blowback, which is disappointing to some, because some are doing it to get the clients to leave, so they've got less to work on, they can manage it in their workload. While they're finding is they made more money off of it, but their problem didn't go away of still having too many clients to work on. So there's a huge evolution going on in this profession right now, and I think it's going to be fascinating. But we'll move past the sledgehammer. But there's a little sledging that does happen. So, Bridget, what are fascinating questions do you have?
So we'll move on. So this next one says, what are the top 3 reasons a deal fails? I would love to hear from both of the panelists on this and how it could fail at either step.
I'll start. I just listed out 3 that we run into from a capital side, which is when one of our borrowers buys somebody, their retention expectations. So when they're telling me that they're going to retain 95% of the clients, sometimes that gets a little out of whack, maybe 6 months into the deal. That's one reason they fail. Lack of working capital is another one. They just don't have enough cash to handle that 3 to 4 month delay after they bought somebody, to handle billing delays, potential hiring issues or things like that. So they just don't plan properly for working capital. And then the last one is overreaching, either on the size of the transaction they're doing. They're buying somebody bigger than themselves, or if it's a geographical problem from location. If they're buying from one state to another and trying to operate that other practice out of state, that sometimes is the reason they run into trouble.
Okay, so Bridget, I misheard the question. I used 3 squared. Is the answer, so I have 9 reasons, and I just stopped after 9 because
I'll cut you off after 5 minutes.
So, 1, value expectations, as Bruce has alluded to, the value expectations it's not uncommon. We have a conversation with a firm, they're like, what's the firm worth? The real answer is what someone's willing to pay for it, but you have to get realistic about how you price the firm. I just had a conversation with a firm this morning, a client of mine that is a passive client that we don't talk with as often, and they're acquiring a small practice, and the practice wants a multiple of 1.2. And then we started talking about their 1040s that are under $400, and they want a multiple of 1.2, which makes absolutely no sense at all. If it was a $4,000 1040, maybe they could multiple over, but second is leadership's inability to give up control. So I want to merge or sell so I can give up some of the risk, but I don't want to give up the ownership. We hear all the time from people that are 65, 66, 67, I'm in my best health ever. I want to sit on the executive committee of the firm, and I'm going to have a 3% interest in the firm only, but I want to sit on the executive committee. You got to be prepared to give up control. Third, emotional decision. I want to go, but I really can't. So I talk like I want to go, but at the end of the day, I won't, because emotionally I can't let go. They're just not ready to do a deal. The poor deal economics, too many low 1040s, lack of staff. So buying a book of business is tough right now. Firms don't have the resources, so buying a book of business makes it very difficult to do that. I've got the wrong size clients. I have a client mix of 1 to 5. Bruce's clients are typically 10 to 100. I can integrate them in, but I have to understand that my practice may not go at the same value as Bruce's, and I may have to make some changes if I'm going to merge into Bruce's practice, because my client base is different. The last 3, material billing gaps. So I bill at $100 an hour, Bruce bills at $400 an hour. That doesn't mean my compensation is going to go up because I'm merging into Bruce's firm, but that gap may be so wide. Our culture may be different. The type of clients we go after, our service model may be quite different, and that gap may be too big to overcome. That doesn't mean a $50 gap or $75 gap's a problem, but you can't expect my clients to go from $100 to $400 an hour, but they could go from 100 to 125. Last two, and the last one's the most important, but too many billable partner hours. So we talk to firms that have 2,000 billable hours per partner. That talks a lot about the big issue coming up next, which is firm culture, and culture is where there really been a big push. If firms don't have the right culture, work-friendly culture anymore, they can't attract staff. And the reality is, if you want to build 1,500 to 2,000 hours a year as a partner in a firm, it becomes a difficult to move firm. And even though the profitability may be very high, it's shocking to believe that a highly profitable firm is because of the fact they've got a lot of partners billing 2,000 billable hours actually has diminished value, because to replace all those partners is a very difficult task to do.
Which one is your number one on that list?
Well, number one on the list, flat out, if there's no cultural fit, goodbye. Because no matter what, even Bruce, if I was coming into your firm for just a year to transition, that would be a nightmarish year if we have a mismatching culture. And on top of it all, there's a good chance a lot of my staff is more in line with the way I've developed my firm versus how you've aligned it.
Yeah, that one should be on my list, as well as the decision to leave, giving up control, and evaluation. I mean, those. So maybe I should have done 3 square too. Sorry, but my number one is definitely the overreaching. Though, is just trying to buy in a different location, either out of state or too far away. But that's my biggest one.
See, that's interesting, because from my perspective, that's not as big of a factor, but from a financing perspective, that may be a factor for you as well. So when you look at the mix here, you have to look at the overall deal. So if you're doing a deal without any financing, that could have different considerations than when you're doing a deal where financing is involved.
I mean, it just bleeds into the leadership control too, if it's in a different state. So if you got some manager that you're buying is over there and they want to run it the way they want to, so that fits into the culture, and it just kind of all blends together. So
it does blend together. The biggest thing is having somebody, I had another meeting yesterday with a different client, and the way we ended the meeting was, it was a good ending. Our client, who is the larger firm, said, look, we want you to take a week or two just to make sure that your head is really in this, that you're not just sampling to do this, that you're committed to wanting to go forward with something like this. Because if you're not, that's okay too. And even if you go forward and it's not the right fit down the line for all of us, that's okay. But if you're really not sure, don't start the process, because it's not like the use of everyone's time. Plus, quite frankly, a lot of misinformation then typically starts to occur. So our clients actually sit, I'm talking to the candidate firm about what their thoughts are in about a week or so, just to get them down. I think that one's going to proceed to a next level. Whether it's a successful next level, we'll see, but they'll definitely meet again.
Okay, these are great answers. I'm gonna move on to the next question that we had for you. It was, I would like to listen to their thoughts on which type of parties to involve during certain types of deals.
Let me kick off. So if I was buying a firm, I would definitely engage someone like Bob, who's a consultant in the industry, and definitely give some advice on how to structure transactions or agreements. But I would leave it to the lawyers to definitely structure agreements if it's a partnership issue or if it's an actual buy-sell. And then from an internal standpoint, have a transition team ready, especially if it's a larger acquisition. So someone that can integrate software, someone that can help with employment contracts, with non-competes, the things that might be necessary for when you do an actual transition. Those are the 3 top ones I can think of.
Bob, how about you?
I'm going to be parallel, but I'll take a little different cut. So using any kind of outside person who understands accounting firm transactions like us or someone else, or if you're doing it in a different industry or for a different client, someone who has some familiarity with M&A and better yet M&A in a specific sector. Because we do see a lot of M&A people that get involved in some of these transactions we're in that do other companies but don't understand the CPA profession, and they actually mislead the client. They don't understand the profession enough to understand how a transaction should be fair on both sides. They also don't know what questions to ask. So a huge mistake that we made and we identified this about 3 years ago. Massive mistake. We thought, we would get an opportunity for Bruce, who's a CPA, managing partner of a firm, and we get him an opportunity to talk to a candidate firm, and that maybe would be you, Bridget, right? We'd put the two of you together, you guys would have your meeting, and the meeting would come back with, it didn't really work out right, it wasn't a good fit, whatever. So after a pattern of seeing this, we said, we talked to Bruce initially, and then we talked to you initially, Bridget. We're like, it sounded like it should be a good fit. So what went wrong? What we found out is if we're not sitting on the initial calls from 99% of our clients, people don't know what questions to ask. So they immediately start asking questions about like, well, Bridget, how much money do you make a year? And let's talk about your realization and utilization, as opposed to talking about like the firm and the vision and where to go, and then sorting through some of those other questions a little bit later. That was a huge learning mistake. The second thing is the attorneys that Bruce had mentioned. So what we do is we put together we call it a draft letter of intent, or some clients will prefer an MOU, memo of understanding. But if I can't get you and Bruce to agree on those terms, there's absolutely no sense to bring it to an attorney yet.
Right.
Because I'm wasting everyone's time. Now, however, the next step is we always caution everybody is Bruce is going to bring it to his attorney, you're going to bring it to your attorney, and then the redlining starts. And because they're all trying to protect their party, right? So one of the things we counsel both parties on before they bring it to their attorney is, look, the document we have in place is a fair document. Everyone agrees it's fair for both parties. The attorneys are there to put it, if I'm representing Bruce, Bruce's attorney is there to get it in a legal format, to give it to you, Bridget, to give it to your attorney, to go, yes, this looks sound, not to start to renegotiate the terms, okay? That rips deals apart, because you'll have a real estate attorney looking at this contract going, well, we need to make this all to your favor, or somebody who does, environmental law, because he's a neighbor of mine, and he starts looking at the contract. The last is the post-integration team. So first time in our experience the other day, we had a larger firm that asked us to identify somebody who could help them with post-integration. That said, we have the people in-house, but we don't want to take them off track and have them do things that takes them off the mission, what they're doing. They know those people, like the director of HR, will have to get involved, but they want the director of HR involved after the post-integration team has already identified what steps to do and then bring in the right people.
That makes sense.
So,
Yep.
It does make sense. And we've identified a few people that can do that work. We don't want to. I don't mean to be rude, but there are people who do that end of it better than we would. They know the software, the systems, the integration, the processes more. And that's an interesting area that I think a lot of firms need help with, because a lot of the deals go wrong because they don't do the integration properly, or they don't talk through those up the front end. Rachel, turn it back to you.
Okay, I'll move on. So the next question is, how does inflation impact deals immediately and then again in the future? Is there a looming recession, and how does it impact the modern accounting industry?
I'll take my part, since it's the easiest. Since at 2:30 today, they're going to be making a decision that immediately impacts, my product. Rates will definitely be affected. If rates keep going up, it's going to affect borrowing costs, which are going to affect prices of practices that you're buying and how much money you have to put into them. I mean, that's going to cause fee pressure internally too from the accounting firm. They're going to have to increase fees potentially to keep up with this inflation. I mean, that's just a basic fact at this point, unfortunately. But I mean, looming recession, it's all the signals are there, but I can't predict that, and I don't think I'm allowed to actually say that as a bank employee on TV right now. But so I won't make a comment on that. I'll leave that to Bob.
Bob.
So like that's a natural theory of economics, right? If interest rates go up, there's going to be more cost and more pressure on cash flow, right? So the thing on how it impacts the accounting firm profession, I'm kind of looking at this one with a little different lens. Okay, will it decrease the value of some of the firms? Maybe, potentially, yes, especially if there's outside financing required to make a deal structure go through. But if there's no interest rate on the deferred comp program and it's put in that way, I'm not sure how much of an impact that's going to have. But again, yet to be seen. The bigger impact I think is going to be is, since there is a good staffing shortage in the accounting profession right now, even if a lot of the clients start to struggle a little bit because of interest rate issues, there's so much work out there that firms are actually just walking away from and not even pursuing, that I think that all of that backlog work would backfill any shortages a recession could create inside the client base for a CPA firm.
Mm-hmm.
But ironically, since we've set a trend over the last couple of years, I think what's going to happen is the government's going to pass a recession relief act that'll have all kinds of tax incentives in it, maybe some recession relief PPP money on top of it all. That's probably too far stretching, but there'll be all these incentives that come out that the CPA firms are going to have to figure out how it applies to their clients. So it's probably going to actually create more specialized tax work for these firms because of the recession, because of the trend we've actually set. I know that sounds kind of crazy, but
no, it doesn't. That's my theory. As long as there is a Congress, there's going to be tax law, and they'll always stay busy in some form or fashion. But I think you're right on the money there with that one, as far as potential tax relief coming down.
There's one other factor here in this recession. It's a little different if we have a recession. I shouldn't say we have one because I'm not an economist. I just play one on TV. So the other thing to give some thought to here is, okay, in prior recessions, we've got this massive aging baby boomers. So 67 is the average age for the baby boomer population that, to my last count of any survey information I had, owned about 60% of the businesses in the United States. So think about that. If the average baby boomer is 67 and baby boomers own 60% of the companies in the United States, there's this rush going out the door, right? Everybody's gonna be cramming into the doorway at one time trying to figure out how to get out, which will have an impact on firm values, right? And I'm looking at this from a recession standpoint. If everyone starts to flood to the door and try and leave, the buyer pool will get more selective, prices may adjust, okay, as well as the impact now is, do I need to use cash in a deal on some of these or not? And if I do, how's that cost going to impact the value of the opportunity that I'm buying? I just think it's going to be very interesting because of this baby boomer. You know, you remember the George Clooney Perfect Storm movie where all the storms converged on the little boat that never made it out in the water? I think we have a little of that going on. And I think it's going to be very interesting. I think the only thing is the CPAs have is they've got that helicopter that goes above a lot of the water because they got the staffing shortage right now. and they can absorb and take more clients if they need to, even if they do have to take some of the.
So am I the boat in that situation? Are you the boat, or is it the CPA owner?
You and I are both, Bridget, we're all in the boats. Are
we on the other boat that's catching all the fish?
It's the CPAs that are sitting way up in here.
There you go.
They're up in the helicopter. But it's look, I've been at this for a long time. Bruce, you've been doing this for quite some time. It's just an environment that I've never seen before. We're getting bombarded with people who are asking us questions about their succession plans, their firm value, how to structure a succession plan. You know, we talked to one the other day. They got a 2-year window to exit. This is a good sized firm. I mean, you know, they're over 5 million, under 10. But they have a 2-year window when basically all the 3 equity leaders are going to leave. And they're putting their income partners in sales training. Why would you do that? Why would you put them in sales training? If they're not selling already, they're not going to sell in 2 years. To learn to sell takes much more than 2 years. So they're going to be forced to have to merge that firm upward because they're not going to have anybody who can bring in the work. But people are grasping at some straws out there trying to figure out if we can put them into sales training, at least maybe I'll get somebody who can buy us out. They have the other issue of how do you convert the income partner into an equity partner to want to buy them out first, which is, Bruce, you've got a funding tool for that, right? This is not an infomercial, okay?
No, definitely. I mean, we do that. I mean, that's one of the things that we specialize in to handle that succession need from a capital standpoint.
Right. So you can fund my buy-in to
Correct.
Oak Street as a partner in Oak Street, and then you get capital into your account, and your guarantee on my buy-in on that is my interest in Oak Street, which either you're going to give the money back to whoever you borrow the money to, whatever's left, and then the interest in the firm is what really is your collateral.
That's correct.
So, I mean, I think it's an interesting product. It solves some capital and cash flow needs. The other question is, how do you actually determine how much the value of the firm's worth? and how much capital is needed for me to buy 5 or 10% of Oak Street. I'm using Oak Street simply as an example.
I know. I want to find out when you're buying part of Oak Street. I can't wait.
We might have to save that for the next webinar. We are actually at time. You guys, you filled that 30 minutes beautifully. It was fast. Thank you so much for your incredible insights. That is all the time we have today. But as we get more content from these two, we will send it your way. Stay tuned for more webinars from Oak Street Funding throughout the summer, and catch our next our podcast episode on Tuesday, June 21st, about hiring and retaining diverse talent. Have a great day.
Thank you all. Appreciate your time.
See you, Bob.
Thanks, Bob. Thanks, Bruce.
For what?